Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the July investment edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weisse, about what's going on in the markets and investment universe that you need to know right now. Bob, welcome back. How's July been treating you so far?
July's been nice, early in the month, but nice to have a long weekend, and markets continue to be pretty positive. So it's been good.
We're having a good market year, obviously coming off a good year in 2023. But that doesn't mean there's nothing to talk about or that there's questions that we're not facing from clients and prospective clients. So what's stood out to you recently that you feel is worth educating people on?
Yeah, I think there's two main topics. And really, if you talk about the stock market and the bond market as topics to address today, and that's pretty much an entire portfolio. So there's a lot to it. And that is the bond part especially is overlaid with Federal Reserve policy that we've been talking about, but it continues to be a central theme in markets. And it really gets, starting with bonds, to the idea that we are around peak rates, peak interest rates. Market is expecting the Fed to cut rates. The most likely scenario is twice this year, starting in September and then in December. So seeing two rate cuts. And just stepping back a little bit, why the market's pricing that in. One of the reasons is we're seeing a slowing labor market. So there was a jobs report, I think it was last week, the unemployment rate ticked up to 4.1%. It bottomed at 3.4 a year ago. So we've gone from 3.4 and in these like 0.1 increases all the way up to 4.1, which historically is not a high level, but the trajectory is not good. They have a dual mandate: price stability, low inflation, and full employment, and seeing the unemployment rate increase is not a good thing. When you look under the hood at the jobs report, what's interesting is the prime age labor force participation rate has risen. So prime age, that's defined as ages 25 to 54, and it's up to 83.7%, which is the highest it's been in over 20 years. And if you think about, well, why are there so many people in that age range looking for work? I think it gets to inflation and the cost of home ownership in particular. As we've seen housing prices skyrocket, it really takes dual incomes to afford houses these days. So the point with all this is we're seeing, and the Fed's been talking about it, Powell is testifying to Congress today, how their dual mandate is very much more balanced in nature. And there's a saying on Wall Street that Federal Reserve policy with interest rates, they take the escalator up, but the elevator down. So interest rate increases are always very measured and gradual, 0.25 point increases at a time. And it could take a year or two to increase interest rates to at a high level to slow down the economy, kill inflation. And then historically, what happens is all of a sudden things start to slow and they kind of hit the panic button, frankly, and cut by 100 basis points, 200 basis points, do it a couple times and they're done. We're not going to get the memo before the rest of the world gets the memo that interest rates are going down. So and what you see is after the hold period, typically the bond market anticipates it and yields start to fall. Yields haven't fallen yet. So this is a long-winded way, but it is a podcast and we have some time, of saying that if you have cash on the sidelines and you're enjoying those 6-month, 9-month CDs at 5%, most likely that's not going to be there for too much longer. And it very well may go back to 2 to 3% CDs as an example. And the time between the 5 and the 2, you're not going to be able to market time it. So you can buy, say, a 5-year bond right now at 5% or so if you take a hair of credit risk. or even get 6 or 7%. So extending out term and getting properly positioned in fixed income is, if you haven't been listening to us and haven't been doing it and have been enjoying those short rates at elevated levels, they're not going to be here for much longer is a base case assumption that I would operate under. So that's kind of last call at the bar for high interest rates is one message here.
And really, Bob, with that, you're not necessarily talking to people in money markets because you're not really locked into your money market. You see the yield drop, you can start to reposition, although there may be other challenges with waiting that long. You're primarily talking about people who own short-term bonds or CDs that may be coming due and saying, don't, redeploy into something that's going to be suboptimal when rates are about to head lower.
That mostly, but the money markets as well, because if you're sitting there happy with a 5.25 yield on a money market, you're going to wake up one day most likely and see that that's at 2 or 3%. And based on history,
So get ahead of it, basically.
it's the elevator down.
Yep.
It'll happen quickly, and then you'll call us and say, "Hey, my money market's down 2%. Can you guys do any better?" And the answer in that scenario is, well, the bond market's down to 3%. It just appreciated by 10, 15%. You missed it. I'm sorry.
Yeah.
So it's just getting
You'll be a little bit nicer when you answer the phone call than sorry you missed it. You'll have a better answer than that, I
I
hope.
will have a better answer. Yes. But that's what history, and I'm not using a crystal ball and predicting. I'm just saying what we've seen historically is that rates do move quickly on the downside, and it's not that we're expecting that tomorrow, but these things do turn quickly, and the trajectory on labor is unfavorable. Another metric we look at is the Atlanta Fed's GDP Now signal, and that's been really accurate for the last couple of years. The Atlanta Fed runs a model that tracks GDP and GDP Now if you were to measure it today, and it's been running based on their model above the consensus for years, basically saying all of you folks worrying about a recession, there's nothing to worry about, and they've been right. That model is now below the consensus, showing GDP slowing, and it's the first time that I've seen it below the consensus in the last couple of months. For prior years, it's been running high. So, the signs are adding up that things might be slowing, and it's just on the bond topic. We still have risk-free yields in the mid-4 range. And you don't need to take much credit risk to get low risk returns in the fives that you can lock in with maturities of 5, 6, 7 years. So that's one just kind of message takeaway as we're in the summer. It looks like rate cuts are going to begin in the next couple of months, being the market's base case on pricing. That it's kind of might be last call to lock these in before we're back to a lower rate environment.
Okay. And so jumping over to the stock market and kind of picking up on your train of thought, at least for now, it doesn't appear to me, although you can, educate me otherwise, that stocks are forecasting a weaker economy, right? I mean, stocks are a discounting mechanism. If the economy is going to soften, if corporate earnings are going to be impacted, you would see some declines in the market anticipating that? Or am I overstating kind of the connection between what the stock market does and how it's a leading indicator to the economy?
No, generally you're correct. What we have seen with the stock market at the beginning of 2024, there was much more broad participation, meaning a lot of stocks were going up, and that has narrowed significantly in Q2, where it kind of stalled out the rally broadly, and the leadership group has been more narrowly defined, almost by companies that are involved in AI. And if you're involved in AI, you're a darling, and you're going up a lot, and everyone else has kind of stagnated for the last quarter.
So if you look underneath the hood, which we haven't talked too much about, we've touched on it, but there has been a lot of this conversation where the market is top heavy. So if you look underneath the hood, there are weak areas of the market, but you're not necessarily seeing in the performance of the index as a whole. And one thing I saw kind of in preparing for another meeting conversation I was having is a lot of those AI names or those large cap growth tech names, have had strong performance because of multiple expansion, not
Yeah.
necessarily because of earnings growth. Could you touch on that a little bit if you're seeing the same thing?
Yeah. So when an asset goes up, when the price goes up, we like to understand why it went up. And there's really two ways that you can attribute, say, a price of a stock to increase. And one is multiple expansion. So say a company is making $100 million of earnings. Say they made $100 million of earnings last year and they make $100 million of earnings this year. But the price went from the total company from 2 billion to 3 billion. That's pure multiple expansion. It went from 20 times earnings to 30 times earnings, and the earnings didn't move. I would look at that and say, that's concerning. It just got more expensive. The fundamentals didn't improve. Conversely, the earnings could go from 100 million to 110 million, and the price from 2 billion to 2.2 billion. And that is a multiple of 20 just staying the same. And so the second case where the earnings growth supported the increase in company valuation, that's more sustainable. That's healthy growth, in my opinion, a healthy investment return. More the price goes up, but the fundamentals don't improve. That's concerning. That's just like the balloon's inflating, but if there's nothing to support it, that typically mean reverts and air comes in, air goes out. So you need to be more cautious when you see markets rising on multiple expansion. And this year, the story, it is a little of each. So that
Right.
there's multiple expansion, but there is earnings growth as well. So it's a combination. It's the companies are growing earnings, but people are getting more and more excited, leading to expansion. So it's kind of compounding the earnings in not a great way.
And
Because
some of those top names are earning and some are not too. I mean, there is a little bit of both in terms of earning growth amongst those
yes.
names, right? They're not all equal in terms of how attractive they are based on their earnings growth.
That's true for sure. It's a mixed bag when you look at the Magnificent Seven of how profitable they are, the level of valuations that they trade at. Yeah, it's tough to make general statements, but in I'll do that anyways. In general, we've seen a multiple expansion along with good earnings growth this year.
So, we started this conversation on stocks, just talking about whether there is the potential that the stock market is signaling an economic slowdown. And that was a great explanation. And we kind of dove into a certain segment of the market that's doing better and the limited participation from other segments. What else were you going to get into? What else are you seeing when it comes to stocks?
Yeah, on stocks, I think talking about AI a little bit
Mhm.
would be helpful. So NVIDIA is the poster child. NVIDIA as a stock has done tremendously well. It briefly eclipsed Microsoft and Apple a couple weeks ago to be the largest publicly traded company in the US. Right now, it pulled back a little bit. So the valuation of NVIDIA now is about $3.2 trillion is the market cap. And to put that into perspective, their earnings are between 40 and $50 billion, depending on how you look at it, if you're looking at net income or EBITDA. So if you call it 50 billion on the high side and look at a $3.2 trillion valuation, that's over a 60 multiple, 60 times earnings. The S&P 500 over the last 20 years has traded between 15 and 20 times earnings as kind of an average range, maybe a little above 20 and a little below 15 at times, but 15 to 20 is generally considered a fair and reasonable valuation for the US market. So if you were to look at NVIDIA and say someday they will mature and stop growing, and what's that level to trade at 15 to 20 times earnings with a $3.2 trillion valuation, you need earnings in the 150 to 200 billion range. So you need earnings to increase by 3 to 4x from the current level, which is a pretty big increase. To put it in perspective, I was just looking up other companies like Walmart, JP Morgan. They both have earnings around 50 billion. So it's like they need to add on a JP Morgan and a Walmart. I think McDonald's is like in the 10 to 15 billion range. Like these are big numbers and that they need to get to just to kind of justify their current value. So if you were to say in 5 years they're going to get to 200 billion and then grow at the market rate, I would say, okay, then stock's probably fairly valued. You're going to get a 0% return. So it needs to do better than that to actually further appreciate from this level, which is a pretty tall order. That's what investors who are buying the stock, if they're analyzing it, should be expecting. So just from an investment standpoint, couple, like some clients have asked about it, so that's why I'm bringing it up, but a couple takeaways, and I think it's interesting. In our client portfolios, we have about a 5% position of the US stock in NVIDIA. It is a big company. We do own it. If you're to look at a general index, it's closer to 6%, like the S&P 500 is closer to 6. So five's less than 6, a little underweight, but it's still a healthy allocation. And one of the reasons why our portfolios are positioned in the US underweight NVIDIA is we kind of shift the weight down a little bit. So we own a little bit more mid caps and small caps and even more of the smaller large companies than the big large companies. Because as you get bigger, it is harder to continue to get bigger. If you were to think about, if you're the largest company in the US market, say you're 6% of the S&P 500, for you to outperform the S&P 500, that 6% number has to increase. It has to become 7, then 8, then 9, then 10, and eventually it has to become 100%. And we just don't think companies are going to continue to climb up that high. And then just the second observation, and this is less investing, but more just say as a consumer, is the stock market, which is pretty darn smart. A lot of people looking at these things and investing trillions of dollars based on this, they're expecting really big things from AI. So if you're a business leader or just a general consumer and like a technologist, you should be checking these tools out. I know we are at Heritage and looking at how we can use them in our business. And they are powerful, and the stock market is telling us, hey, we're expecting really big things from these, more than I think probably the average person is. So it's a trend that I think is worth staying on top of and monitoring closely if you're listening to what the stock market's telling you.
Great. Yeah, that makes a lot of sense. Thanks, Bob. And then pivoting away from stocks and bonds, you and I wanted to talk about another investment type. And what would you consider it, Bob, private credit? Is it an alternative investment? Is it a type of fixed income? Kind of what role does it serve in a portfolio? And then, there's been a lot more talk about private credit. I've seen through the content that I consume. We've owned it, 16 years or so in different through different vehicles, right?
Yeah, 15 years.
So you have a lot of experience with private credit. Our clients have a lot of experience with private credit. So I thought you'd be a tremendous guy to chat with about this. So, I asked you like 5 questions there in the form of an introductory question. But first of all, what is private credit? What sleeve does it fit in the portfolio? And then, how would you educate people as to what it is?
Yeah, so private credit, really the story starts back in the financial crisis in 2008. So back then and before 2008, banks like the big Wall Street banks and Bear Stearns, Lehman Brothers, as poster childs of this, were known for making loans in addition to being a bank for savings deposits. So, consumers would and businesses would give banks their deposits, and then banks would take the deposits and turn around and make loans. And at that time, they got pretty heavily levered, I think up to like 40 to 1. So they'd take all the deposits and maybe hold back 2.5% of the deposits, but rest of it would go out into risky loans. And what happened is those loans go bad, and then there's no equity left, and the depositors lose everything. So that's kind of 2008 in a nutshell. And what happened then is regulation came in, Dodd-Frank, Basel III, and that really put limits on how much the banks can lend and what types of risks they can take with their reserves. So when they have your deposits, can they make more risky loans, or should they maybe put those deposits in treasuries? And then the regulations have put them more into the invest your deposits in treasuries. They still do some mortgages, but the risk has shifted basically from banks to the private sector and investment firms to make loans. So if you're a private business and you need financing, 20 years ago, you might go to a local bank. Nowadays, you're going to private credit lenders. So this whole market just shifted. It left the banks who were there making the interest, and went to firms that specialize in making loans to businesses, to private businesses, and that's private credit. So they're looking to raise capital from investors with the sole focus of making loans to private businesses. And the objective there, it makes sense to me, is that it's you know what you're getting into. Like, we're looking to raise money to make loans to private businesses, as opposed to the banking system redirecting deposits to private loans to make a yield spread by taking risk. So that's kind of just the evolution of what's happened, getting a little more into it, how it's grown. So it's kind of born really after 2008. And the opportunity is there in a big way through private equity. So with private equity, what you frequently see is they will buy companies with a combination of equity and debt. So if you think there's a parallel to real estate, like even with residential real estate, most people buy a house and they have a mortgage with it. Or if you're investing in commercial real estate, same thing. You have some equity and some debt. So private equity does the same thing. If they buy a company, there will be an equity check that the private equity manager brings, but they'll also do some financing. They'll borrow money to help buy the business. And the loan that they use to borrow to help buy the business is the private credit piece. So frequently private credit, it's lending money to private equity firms to buy private businesses. And they look for reasonable, LTVs, loan to value, just like you see in real estate, so that they're backed by the equity value of the company. And some of the positives about it are the interest rates are high. They're around 10 to 12% typically. So as an investor in private credit, that's the type of yield that you're seeing in today's market. Another benefit that has been realized over the last couple of years is they're typically structured with a floating rate. So the loan isn't fixed. It's like Fed funds rate plus a spread, or prime rate plus a spread. So as we've seen rates go up over the last couple of years, private credit investors have benefited from a increasing interest payment. Whereas investors in traditional fixed income securities that have fixed payments have seen prices decline as rates have gone up. And maybe lastly, one additional benefit of private credit, when you're investing in what's called the sponsor-backed deals, where private equity is the one borrowing the money, you have the backing of private equity. It's not you're just relying on one company to pay the debt. But if the company starts going south, the private equity manager can call additional capital, can do whatever it takes really to see that the debt is good, because if they default on the debt, the equity becomes worthless. That's how capital structures work. Debt holders get paid before equity holders get paid, and the private equity manager doesn't want to write their equity down to zero. So you kind of have a bit of a backstop there. So our experience, in the last 15 years in this space has been a pretty stable source of return, for our clients, doing better than the bond market, and the volatility has been, pretty reasonable. There are critics of the space. I do think a lot of them come from traditional Wall Street, who are not participating in this market and view it as a competitor. And they're either criticizing this market or trying to get into it. So it's a hot topic. It's either, really, depending on who you talk to, it's either I don't like it because I'm not in it, or we're working on a vehicle to get in it. That's the general structure. Maybe the last thing on how we invest in private credit for most clients, we use a product called an interval fund. So it looks like a mutual fund. It has a 5-letter ticker, ends in an X. There's a prospectus. What's different about it is you can only sell the fund one day a quarter. It's for sale at different intervals, a quarterly interval. And on that sale date, the fund legally has to make 5% of its net assets available for sale. So if the fund has $1 billion in it on a quarterly basis, on that quarter, there's 50 million in cash that's available. So if 3% of investors hit the sell all button and no one else trades, then they get everything they asked for. But if 10% of investors hit the sell all button, the manager only has to offer 50% of that sell all. So they give them 50 cents on the dollar, and I can see you next quarter. Again, this is kind of the message. So the structure limits liquidity. And what that does is it allows them to invest in illiquid assets, namely private credit in this case. The liquidity profile lines up nicely with that 5% a quarter, because the average term of a private credit loan is about 5 years. And if you have a 5-year bond ladder, that works out to 5% mature in a quarter.
Yeah. So 50 cents on the dollar, not 50 cents of every invested dollar. You basically get half of your what you want, and then you later get the other half. How do you decide with something like this how it fits in a portfolio? Where do you allocate it? Do you take it from bonds? Do you take it from a combination of stocks and bonds? If yields were higher with traditional fixed income, would you be less excited about private credit? How do you think about it as an asset allocator?
Yeah, the base case is we use third party capital market assumptions to have assumptions around the level of risk in the asset. And in a nutshell, it's between stocks and bonds from a risk standpoint. So when you fit it into a portfolio, it really by default draws a little from each, a little bit from stocks, a little bit from bonds, so that the risk looks more in the middle. But we can toggle that a little bit. So if we want the portfolio to be positioned more aggressively, we can pull a little more from bonds. And if we want to position the portfolio a little more conservatively, we can fund it a little more from stocks. So we have shifted from time to time. Where is it split down the middle? Let's call it funded half stocks, half bonds, or is it split all bonds or funded all stocks? So we have used it to toggle a little bit to kind of drive the overall level of risk in the portfolio.
So, Bob, you've been a chief investment officer who's owned this asset class for 15 years.
Yes.
So you followed it, you know it, you're not kind of Johnny come lately to the topic. What have you seen in terms of risk? Are there a lot of defaults in this space with these loans? What kind of risk have you seen? I don't want to get into a debate about volatility because there's less volatility with an illiquid investment, and some people would not give the investment credit for that lack of volatility, which I can understand. And I don't really want to get into what is a very nerdy and pointless investment debate. So maybe defaults is a better way of capital loss. What have you seen in different economic environments? Because we had COVID when things temporarily slowed down. We've had other slowdowns. What type of risk have you seen? Because we've done it through private investing, we've done it through interval funds. You've seen a lot of strategies. What are your observations?
Yeah, it's been a good asset class. I mean, I've heard people refer to it as the gift that keeps on giving. It has delivered a good yield for our end investors, and the risk has been lower than we've expected. When we look at our modeling and the numbers we've put in, we have not realized the risk that we're expecting from it. So you could say we've been too cautious in our modeling, that we assume that it could have bigger declines than we've seen. But I don't think that's wrong in the sense that that risk isn't out there. Private markets in general have done pretty well over the last 15 years. And what we do here is worry about risks. And there is the risk that private equity has a tough stretch, and that would tie into a tough period for private credit. So I think it's important to not get in over your skis on it. We have had some clients, want to put more money in it than we're recommending. And we do caution them, like, don't be greedy here. If it's working, it's working. But we allocate a small piece and let it do its thing, and at the same time, don't get overextended there. So our experience has been quite positive in the asset class. I think it's important to diversify. There are more niche players in the market who don't have diversified portfolios of loans. And when you're dealing with loans, I think it is important to know that any loan can go bad, and you want to own enough so that inevitably when some do go bad, you have enough diversification that it doesn't sink the portfolio. So we've stayed away from the more concentrated funds. That's been good. And we've also stayed away from the riskier ones. So don't chase yield. Like if you can get a low to medium risk 11% or a high risk 15%, we'll take the low to medium 11 over the high 15, because that 15 may not materialize if risk happens, which inevitably it will. So we've been a little more on the defensive side within it. And I think that has paid off and led to pretty good returns for our clients.
So, Bob, these are private loans. They're not bonds, so they're not rated. So
Correct.
do you have a sense of the credit risk that clients are facing in vehicles like this?
Exactly.
Is it like comparable to high yield, or where do you kind of put it in the credit risk spectrum?
I probably would say it's comparable to high yield, but the way they look at it, like with the LTV being, say, around 50% on average and backed by private equity, you just haven't seen the losses that you've seen in high yield. Like through 2020, you would have done much better in private credit. Our clients did better in private credit than they would have done if they held a high yield ETF, as an example. But part of that you could argue is the mark to market. And what I mean for our listeners by mark to market is like publicly traded bonds or stocks. The price is the last trade. And bonds, they can do some what they call matrix pricing. I won't get too technical, but just say it's basically the last trade. And if it's March of 2020 and people are panicking and everyone's hitting the sell button on risk securities and no one's buying, the price can fall through the floor. And a fundamental analyst could say, no, that price isn't right, but they have to report it. That's the price, the last trade. So part of maybe the perceived lower risk of private markets might just be due to the fact that there's not the emotional roller coaster built into the pricing mechanism that you live through when you're invested in securities that are traded publicly. And people like Cliff Asness will argue that all day long from AQR, and he's not totally wrong on that front. The lack of getting a mark every single day does make it look like it's less risky than public assets, when the fundamental risk, say if you're measuring risk not by variance in price, but say probability of loss of capital, could be more similar.
All right, yeah, that makes sense. So we did kind of dive into the nerdier part of that debate, which is fine. It's good. It's good to get into. I'm glad you teed us off with it, not me. All right, well, Bob, I appreciate the overview. It sounds like you're comfortable with where markets are, but you're watching some things, particularly with the bond market and where rates are going, and maybe looking under the hood a little bit deeper at the S&P and seeing where there may be some more opportunities for stock investors beyond just kind of the big names that are concentrated at the top.
Should have said that from the start and head on, Sammy. That well said.
No, that'd be too short of a podcast, Bob. We got to get people their money's worth. So thank you. I really appreciate your insights today. And
sounds good.
All right. Talk to you later.
Sammy, bye.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.